Notice to all viewers, the past performance does not guarantee future results. The information provided in this video is for educational and informational purposes only. It should only be considered financial or investment advice. Always ask a financial advisor before making any major investments.
Ever wonder, is YieldMax ETFs worth the investment? Everyone talks about NAV erosion. Everyone talks about there's lack of growth. But is YieldMax really worth investing any of your money into it? Hey, welcome back to the channel. I'm Doug, the retirement guy. We're going to answer that exact question, I believe, with full detail. Exactly, is YieldMax worth the investment, or is it not worth what's going on? Let's get into today's video. Before we do, don't be afraid to hit that subscribe button, hit that bell notification. Don't be afraid to join the community, because all we're trying to do is help you grow your pocketbook and grow your portfolio. So how does YieldMax ETFs really work? Well, we're going to explain it to you. I'm going to call it from a little higher level, because not every single fund operates this way, but overall, this is the policy that YieldMax uses to give you a total picture of what goes on. YieldMax ETFs seek to generate weekly distribution income by pursuing option-based strategies on one or more underlying securities. In one line, that pretty much answers it all. They are designed to generate income from option-based strategies. Okay? Now, how do they do this? Well, YieldMax aims to harvest compelling yields from assets that are not typically associated with a monthly or a weekly income. The funds do not invest directly into underlying stocks or ETFs. So what we use is what they call a synthetic stock exposure, which basically, I'm going to put in layman's terms for you, is that you own an asset, you own a stock, you own whatever, and you're selling an option onto it as a buy call or a sell put on you holding the stock. I basically say, I will buy it for this pre-agreed price. Here are my assets to prove to you I have the money for it. And we agree to that type of application. I'm not buying it. I'm not stepping up and buying it. I'm not doing anything. We have an agreement that I can buy it for a certain price. I then go out and sell out of the money call options. Okay? So I'm putting this thing out there on sale to try to get someone to basically purchase the premium, purchase the option of the underlying exposure, the underlying piece. And from that, I collect premium income. Now, sometimes I have to buy your fund and fulfill the agreement. Other times, I can just collect the premium income. And when I say me, that is YieldMax doing that. So what that does is that creates a weekly income from those out of the market call options, and it gives you a little bit of downside protection. And also, the big negative to it is it caps your upside. This is why YieldMax funds, when you see them, that when they go down and they stay down. They don't come back up because they're not built for growth. They're built that it's all income, income, income. So this is one of the things that you always have to understand, why YieldMax funds go down but don't come up very quickly. So let me show you this. The market performance characteristics. YieldMax ETFs show distinctive performance characteristics based on market conditions. So in a flat or down markets, you can see the underlying stocks or the underlying performances normally drop off dramatically. But in the ETF side of it, it holds a slower drop-off point. Option premiums provide a buffer against losses. They generate positive returns when underlying assets are declining. That's what put options do. And premium income supports performance during down market turns. Now, in strong markets, complete opposite. In the green line, you'll see the underlying will fly off the handle. It'll grow, grow, grow. And you'll see ours in the red is slowly moving forward because the sold call options cap your upside potential. So like we've always said, if you're going to sell something for $10 and the market takes off and goes to $15, of course everyone would buy your $10 fund because they make $5 just by buying it. And that's the problem. To us, it's a $10 value. Them, it's a $20 value. Missing out on substantial capital appreciation and underperforms compared to the direct stock ownership during bull markets. So the whole thing here, this is the trade-off that we talk about. It's the trade-off that you're going to generate income, but you're not going to get the growth that you expect. And that's where people don't always understand about these ETFs. So here's what I showed you, a nice comparison of what we've done is the high volatility tech ETFs. We put 3 of them on the board, and these are really ones that dialed into. We'll start off with the Tesla, and the underlying asset is the Tesla stock. So TSLY from YieldMax the yield has been 129.35%. It's had a year-to-date growth of negative 40% for a total return of 89.31%. Phenomenal numbers. Now we look at Tesla. Tesla itself has 0 dividends, has no yield. It had a growth of 9.0% this year and a total return of 9.02%. So when you look at these two, first off is who you are and how you look at things. One, I'm getting 129% dividend. No, you're not. You're getting 129% yield minus your growth to give you a total return. Now, you're looking at a 40% loss on the fund when Tesla's up 9%. So who is the actual winner here? Well, technically it's going to be TSLY because you're getting an 89.31% total return. Take a look at CONY, the Coinbase one. Again, 153% dividend yield, negative 45% growth for 107% total return. Coin on the other side is up 43.78%. So people will ask, why am I not getting that 43% growth in CONY? And then the final one that we use is probably about the best comparison across the board. NVDY versus NVIDIA. So the yield of 80.04% with a 32% market loss gives you a total return of 47.53%. NVIDIA paid out a 0.02% dividend yield, had a market growth of 36.39% for a total return of 36.41%. So the question comes into which one would be better to buy, the actual NVIDIA stock or the NVIDIA ETF? Well, the answer to it is well, we're within 11 percentage points from each other. Do you want income or do you want growth? That's what the question here is. Now, you can take and reinvest your dividends back into NVIDIA. You can invest your dividends back into NVDY and make the thing grow bigger. That's one way of doing it. But you're taking away from your income to grow the fund. So despite the high yields, like up to 153%, these ETFs underperformed their underlying stocks. And when they say underperform, people will look at is the funds are down. This is always looking at the growth side. It is down compared to the growth of the actual fund. But the total return is a much higher with high yields. And that's what you always have to watch for is what is your total return? What is your total return of it? And it demonstrates the trade-off of high income at an expense of capital appreciation. This is why I put the question out there. Do you want income or do you want growth? Which one would you like to have? Now, high yield products are going to have what I call the roller coaster ride. You're going to go up, you're going to go down, you're going to flip yourself completely around. You got to have a stomach for these things. Okay? When you're buying the actual stock itself, you have to put a lot of money out there for it, and you got to sit and wait for the growth to come to you. And then you have to sell off your extra shares to create the income. So it's really, do you want income or do you want growth? So let's show you the 4 best YieldMax funds for income. Number one is ULTY. It's the Ultra Option Income Strategy. Now, a lot of you probably know this. A lot of you probably own this. The yield, 88.53%. Phenomenal. The growth, though, is off 40.02% for the year to date. So that gives you a total return of 48.51% return. It pays a distribution average of 9.5 cents. Now that's not guaranteed. That's not locked in stone. This thing you could come to a point where you get no dividend from them. But basically, on average, over the past 12 months that we were able to calculate, since it's went to weekly, pays 9.5 cents. That gives you an income ratio about 1.63. SLTY is the sister side of it, the ultra short option income strategy. They find companies that they want to short to generate the income. Now, this is a newer fund, so the yield is only 67.9. It's only had a 20% loss for a 47.06 total return, and it pays 61.3 cents per share per month, or excuse me, per week. But again, that's an average. That's not guaranteed in any way. 1.52% income ratio. LGFY, crypto industry and tech, 72.73, down 27% for a total return of 45.30. So that gives you an income ratio of 1.33. And then the YieldMax Universal Fund of Funds. This one here is a 61.50% yield with a negative 25% growth for a 35.68% total return. And that gives you a 1.20% income ratio. Now, the thing is, all of these funds are not just dialed into one particular fund. They're not working with the Teslas. They're not working with the individual packages. These are the ones that we rated as the top 4 because of their income ratios. And they have done something that YieldMax is very good at, is spreading the risk across multiple platforms, about multiple stocks, about multiple funds. Okay, your growth is limited. You know, you have limitations on all the growth because they're selling options. So that's the whole key factor to this, is you can see big yield. Big yield can generate less, loss in growth. But you want to always take a total look at total returns. And this is why I think YieldMax actually does very, very well when you look at total returns with the income ratio. Now, the key risks of YieldMax ETFs. I keep saying it, and I'll always say it, it's the cap side potential. You're capping your potential for growth. So these things, again, will not move. The value of the fund is not going to go up very, very quickly. You have full exposure to downside volatility. So these ETFs maintain 100% exposure to the underlying stocks price, movements, options contracts. So you got to be very, very careful to watch your downside volatility. Now, like I said earlier, there is a little bit of protection out there, but not as much as it will that saying it'll never go down. Of course, they will go down. Stocks will go down. Okay. The next, risk of capital erosion. This is what a lot of people talk about. NAV erosion, NAV erosion. It is a real fact on these funds. That's why you have to have large yields to be able to handle the erosion. And the strategy is complex. I'm telling you right now, this is not something I could go out and do. This is not something I think the average Joe investor could do. But YieldMax has professionals doing this, so we allow them to do it. Now, a lot of their funds, I'm going to tell you straight out, have limited performance history. YieldMax ETFs were launched in 2023, so they're very, very short on track history. So you got to make sure that what you're getting into is you have to know how long has it been out there, what they've done, where we're at with it. Should consider YieldMax ETFs? I believe for retirees and income seekers, I really think this is definitely something for you to look at. Okay, you're going to get immediate cash flow if you're willing to sacrifice some long-term capital appreciation. But when you're in retirement, what do you really want? You need income versus growth. You've spent 30 years of your life or more trying to grow your portfolio. And now you want to spend, and that comes from income. Income priority. Kind of killed this one already. This is not built for growth. This is built for income priority. So this is why I put it over, and you see here, I always do this. I put a small portfolio allocation into weeklies, into, and break it down again, into select brands like YieldMax. I don't go in and put my entire portfolio into one category. I don't take it and say we're putting 80% of our stuff into YieldMax because I want income because the guy said to. What I'm saying is if you take a small portion of your portfolio, because so much of this is simple, a small portion can generate big income. Okay? And that's why you want to balance your portfolio across the board. You do not want to sit here and put all your ducks in one basket. You don't want to put all your eggs in one basket. You want to have a small little portion across the area. So my final verdict, YieldMax ETFs on the balance scale, the balance of growth versus reward, guys, it's going to lean all over onto the yield side. There is no question about it. This is not built for growth. There's a way of making it work on the growth side, but it's not true growth. You really need to make sure you understand what's going on. This is not a good fit for everybody. This is for particular situations, and I tell you again, a little bit goes a long way. It's not good fit if you don't need income right now. So if it was my kids who are just starting to invest into retirement, I would not be putting them into this packages. I would not be putting into this. I would be telling them put it into the growth funds like a VOO or something in the S&P 500. Let it grow. This is not where I would put it to. But if you want income, this is an area where you want to do it, but you got to do it wisely.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.